This is Behind Closed Deals.
We'll be chatting with multifamily maestros
Uncovering their strategies
and unraveling the latest market happenings.
bringing you intel you can't buy. Hello and welcome to our podcast, Behind Closed Deals. I'm Hannah Ott at CBRE, based here in Indianapolis, and I'm joined by three of my teammates today, Cameron Benz, George Dickajohn, and Sean Pingle. And we are four of the five brokers on our team here that handles all of Indiana and Louisville. We are missing our fifth broker today, Claire Hassfurther, because she welcomed her second child into the world. And so we're excited for her to be taking some time with them. And excited to give you guys an update today on the first half of this year. We're recording this on July the 29th. And so we're going to talk a little bit about what we are seeing live in the market, what has happened this year, both with deals that have closed, come to market, are pending. We'll also talk about what we're seeing in the rental market from occupancy, rent growth, hopefully not rent decline, but also in the sales market. We're going to hit on a couple of sales that have closed this year and hopefully have some good banter back and forth about what we're seeing actively in the market. So I'm going to give you a quick overview of what our pipeline has been like for the first half of this year. So at the end of June, our team had closed 21 deals. We've actually closed a few more since then, so we're up to 24 deals. But our first half of the year was very active, and 21 deals closed, which represented just under $700 million in volume. We have under contract 15 properties right now, which is another $500 million in product. And there's also a lot actively on the market. We have somewhere between 18 and 20 deals either coming to market. 4 or 5 are actually on the market now. Another handful are preparing to come to market. So we have a lot that we can talk about, because we have a lot of deal exposure, buyer exposure, talking to lenders. In addition to deals that have come to market, closed, or are pending, we also provide a lot of brokers' opinions of value. So far, we've already delivered this year 350 BOVs. We are not as popular as we used to be when delivering BOVs, because one of the things you're going to hear from us is that pricing has adjusted and unchanged. And so we're always doing our best to deliver the best, most reliable information to our clients. So, George, tell us a little bit about what we're seeing in the market from an operations standpoint, rents, occupancies, and then we'll put it from there.
Well, really quick, just to talk about our first half of the year. If you remember, in the beginning of the year, we brought out a ton of listings. And then we made deals on all of those. And then around Easter, it felt like we were making deals on everything that we brought out. But the next step and the next wave of listings was supposed to be around Easter. And there was like a 3 to 4 week gap where the market was really slow. There wasn't a lot on the market yet. Do you guys remember that?
Yep,
And then that
exactly.
was the tipping point to really, like, when we really started very consistently bringing out 2, 3, 4 listings every single week, month, whatever it was. And there's really been no slowdown since. It's just kind of interesting.
And
That's right.
generally what we're selling or properties we're bringing to market are for owners that have to sell for any number of reasons: maturing loans, returning equity, alternative use for capital. Not many people selling just purely to take a profit.
Right.
Just, that dynamic is just not here right now.
Yeah.
We do have, I think, quite a bit more volume than many other markets in the country, and Indianapolis has always been that way. And I attribute that to the fact that we have a lot of non-local owners that don't have long-term ownership time horizons, so tend to be a little bit more rapid turnover. So every 3 to 5 years rather than every 10 to 20 years, or holding on for generations.
Yeah. And then I don't know about you guys. Every time we quote the stat of 408 BOVs or whatever it is, if we tell it to anyone in person, they're like, that's not true. That can't be true. Yeah, it
We
is. It is.
we
I think it's
we
true.
yeah, we pride ourselves on constantly improving our systems. So our underwriting team, our analysts, led by Logan Broniker, have done amazing things, expediting, improving, and automating our underwriting models. We're using AI more. We've automated a lot of it, so they can crank through. The team of three can crank through BOVs very quickly, and they're still very detailed. We don't skimp on
Right.
the details to the extent that we can. And then one of us will always review them before we send them out to the customer. So
But-
we look at them with the eye of what's happening in the market real time before we send
And
them
that way
out.
we
So
have more time to spend doing the critical thinking and thinking analytically about what's going on in the market rather than doing the grinding out inputting numbers, and we can think critically about what's going on in the market.
Right.
and so what we have seen, as Hannah mentioned, we do our best to have accurate BOVs, but generally there's a 4 to 6 month or 4 to 8 to 12 month lag between a BOV and when we close a property. And we've just been seeing I'll call it a slow drip, drip, drip decline in values. It's been a slower decline on the uh, newer vintage Class A product and a little bit faster drip, drip decline on the older vintage, 60s, 70s Class C product. So we again, we're underwriting and trying to meet the market as we see it.
Right. But what's amazing is that even though there's been a drip in value, slowly over time, our BOV count is still going up. That's our best indicator to our future pipeline of how many properties we'll sell. 408 BOVs year to date, 7 months into the year is pretty incredible, right? That means that we're going to do more BOVs than we did last year, which was more BOVs than the year before, and on and on and on. Meaning we should continue to sell a lot of properties in 2027, 2028.
The other thing we saw last year and maybe the year before, a lot of new investors or investors sort of refocused or focused on Indianapolis, and we heard Indianapolis and Columbus because they had previously been down in the Sun Belt in the growth markets, and because the supply struggles in those markets, deals didn't make sense a year to 2 years ago, so they were focused on places like Indy, where our economy, our rental market, our supply is all still pretty stable. What we're hearing now is some of those folks have gone back to the growth markets because they're getting better deals. I think prices maybe have adjusted more in the Sun Belt, and so there may be better deals than there were a year or two ago. Indianapolis is still held very steady and is moving upward positively from a rental market. So I'm going to give some quick statistics. So it's definitely slowed down from a couple years ago, rent growth and strong occupancy, and it's slowed down from last year. So in 2025, overall average rent growth for the whole Indianapolis region was 3.6%. As of now, and this is still preliminary, we're probably 90% finished with our annual rent study. We're expecting rent growth of 1.5% this year. We are seeing occupancy is down from last year. Last year, occupancy was 92.2%. Preliminarily, we're at 91.8%. So that's down just under 0.5% from last year. So rent growth is still positive, but it's a much slower growth.
What do you attribute both of those, George, to? Slower rent growth, positive but slower rent growth, and a little bit of a decline in occupancy. What do you attribute that to?
Well, we have had a few submarkets that have had quite a bit of deliveries. Some of the Hamilton County submarkets where there's the most growth, and this has happened in cycles throughout my 40-year career. There'll be a spurt of construction, a slowdown in those markets, and then they'll they'll absorb it over time. But some of those markets are have delivered many thousands of units, and so have seen a decline in occupancy, increase in concessions, and slowdown in rent growth or decline in rent growth. But for the overall market, it's still slow and steady for most submarkets where there hasn't been a lot of concentration of construction. We're still seeing rent growth. What we're hearing is higher renewal rent growth than new street rent growth. In other words, people are getting bigger renewal bumps than they are getting increases of new people walking in the door.
So
That's
on
right.
another one of my favorite real estate podcasts, The Rent Roll, they quote a stat every week about how wages are increasing more than rents. And so apartments are becoming more and more affordable. Do you think that's true of Indy?
I think wage growth has not kept up with expense growth, Cam. So family net income, after
Right.
their expenses, probably haven't kept up. So I do think there are more and more people strained in paying rents, both on the upper end and the lower end. Maybe a year and a half or 2 years ago, I would have said more on the lower end, but I'm hearing that even newer properties, they're having struggles with people qualifying or being able to pay rent. So I do think there's pressure on family budgets,
Yeah,
even
I
with increasing
agree.
wage growth.
I think that wage growth might be more than rent growth, right? That we're seeing a $20 increase in rents every month. I think that wages are going up more than that. But I think all the other expenses, the utility bills, your food budget, when you have to go to the grocery store, all those things are going up significantly more than wage growth still. And so it's just harder to pay your rent when all your other expenses, rent's the biggest one, but everything else is going up.
Which
One of
these
the
are
pro-
all good signs for Indianapolis and Louisville because of our relative level of affordability compared to the rest of the nation. Recently, the Wall Street Journal posted an article about how the number of over $1 million home sales in Louisville had increased dramatically because these high earners from other markets where they were making more money but wanted to have good quality of life and nice housing. The pitch for Louisville was better than it was for the East Coast, for example. I think the same thing extends to Indianapolis, where the quality of life and the relative level of affordability is part of why people are continuing to move to Indianapolis and to Louisville, because you can have a good job, good quality of life for significantly more affordably than you can in the East or West Coast.
So the question is, do you think that when someone moves to Louisville and buys $1 million house, are they working remote or did they relocate to an office in Louisville as well?
That's a question, and I think right now the answer is that they're working remote. Louisville's working on bringing more jobs to downtown and the East End, but that's a work in progress. And with the increase in the ability to work remote, I think the people who are moving there are doing that.
So it's like the opposite of the COVID trend where you left Indianapolis to go work poolside in Hawaii for 2 months, and now now you're working
Yeah.
poolside in Louisville.
Now
Yeah. Yeah.
one
Um,
other economic thing before we move on to deals. Um, because construction costs have gone up so much and rents have slowed down, we are still seeing deliveries, and we will see, and I'll have more statistics on our next podcast on actual deliveries for this year, but it is definitely going to be slowing down next year and the year after. Basically, no new construction makes sense without city incentives. And because of SEA1, some of the new tax uh, laws that have passed in Indiana, some of the municipalities are more squeezed for revenue and have less revenue to funnel into incentives into deals. So I think we're going to see a dramatic slowdown in new construction, at least for a period of time until costs and rents balance out better.
Yeah. The past couple days, I've been doing calls with a developer friend of ours for a potential construction lenders for a deal in Lafayette, right? And the construction lenders, this is just how it shows how important data is, and you just can't broad brush everything. Is if you look at Lafayette, you're like, on Coastal, you're like, oh my God, there's so much supply coming online. What's actually happening is 80% of that supply, probably even more, is all student and just irrelevant to the property, right? Because if you want to go work at you're a conventional renter and you don't work for the university or you don't go to the university, you're not going to go rent by the bed in a high rise in downtown West Lafayette. It's not an option for you, right? And once you remove all of that, it's like, well, the supply story is actually pretty good. We're adding 1,000 jobs across the street at a chip plant. We're adding a couple of hospitals, things like that. But then on top of that, they're like, okay, well, let's pull up the rent comps. Like, well, this property next door, the rents are $300 below what ours are. Yep. Oh, well, that guy has owned the property for 5 years. He built it himself. He's a local Lafayette guy. The family lives off the money, right? And it just shows that if you were just broad brush, pull something from CoStar and say rents are up 1% or supply is way over, what the existing base is, that is not enough research to really underwrite a deal today.
No, and for sure, the third party providers, when they're doing their projections, they're using deal announcements and having tracked new construction deal announcements and having tracked new construction in so long. A lot of those deals will not happen or will not happen in the time frame that the developer is expecting. So I think some of them overestimate the amount of supply coming in future years.
Right. You really
That's
have to
absolutely
talk to the
true.
locals. Yeah.
We ran into that in Smyrna Village, a deal that we have recently been marketing and just made a deal on. Um, the CoStar report for new construction made it look like there was a ton of projects that were all going to deliver in 2026 and 2027. But when you went and actually talked to those developers, many of those timelines have been delayed. So we had a lot of people who made some assumptions based on CoStar information when the reality is different on the ground.
That's right. All of these things are impacting sentiment in the market, both from a seller perspective and a buyer perspective. Somebody else said this when I was in a meeting recently. They said seller sentiment lags the market, or seller sentiment over pricing is generally lags the market by about 6 months. So when they think pricing is here, and if it's gone up or down, it usually takes 6 months sort of for a mindset to change. And so we're also seeing all of these things that we talked about now are impacting buyer sentiment and how they're underwriting. And two things that we have to talk about, or we wouldn't be talking about what is going on in the market that's impacting the market, are interest rates and the war in Iran. When we started the year on January 1st, the 10-year treasury was 4.1%. And the hope, at least my hope was, is that we were going to see some threes this year in terms of that the rate was going to, continue to maybe come down. Here we sit today at a 10-year treasury that's 4.629%. So it's increased about 50 basis points, which is more than 10%. Also, and in that slowdown you talked about, Cam, the war in Iran has impacted sentiment. And so I think we should tell our listening audience what we're seeing, how those two things are impacting underwriting, especially when you layer in what we have just discussed in the market with what's happening with operations. How are you guys seeing this actually impact how the equity market is behaving?
Well, along those lines, we've been amazed that properties have been selling for negative leverage since COVID or maybe even before COVID. But our explanation for why a property would sell at a cap rate below a mortgage constant is everybody was doing IO deals and assumed that when it was time to start paying principal and amortizing, the rents would have gone up and they can afford to do that. A lot of the BOVs we do are for properties that are about to end their IO period and they just wouldn't cash flow very well and provide the investors with a good enough equity return. So I think we're seeing a decline in pricing and an increase in yield requirements because Number one, people aren't assuming they're going to be able to refinance in the near term in the next 2 to 3 years at a much lower interest rate. So they have to have the cash flow day one with the loan that they're putting in place. So I think that's probably having as big an impact on pricing as anything else. And then, of course, slowing down in rent growth has an impact on pricing, especially for the newer product.
Yeah. I feel like if you were to ask me as an investor, what would you want to put your money in? I would say I don't want to lose my money and I want to put my money into something that actually produces cash flow, right? Because I don't want to speculate on the market. And I think that's what we're seeing just as an overall generalization of the equity market is that I want to have a lot of conviction in whatever I'm investing in. It better be a good deal. There has to be a real reason to buy it. And when I buy it in the first year, I need to see some amount of cash flow come back to me because why else am I putting money in?
And I agree with that. I think multifamily rental real estate is one of the safest places, and the market recognizes that. And we have seen no decrease in interest in buying. It's increased. I mean, we have more and more people wanting to buy and very few people getting out of the market. All that's changed is pricing expectations. But the demand to buy apartments, especially in a stable red state place like Indiana, Indianapolis, is still very high and I think increasing.
Yeah, I agree. I
You know,
just
you
don't think there's as much speculating that pricing is going to go up. It's just I need to see 5% on my money year one or 4.5% year one. And I want to be in something new that doesn't have a lot of capex or in a great location.
use the phrase the word conviction, and we're talking about that a lot, is there's not a lack of capital in the market. There's a lack of conviction that things are going to be different than they are now. And there's a lack of speculation. So how are people making decisions to buy deals now? They're relying on the data. And we've talked about how data is so readily available, but the devil is in the details. So you can get just about with AI and data providers, you can get just about any data that you want. It may not be accurate though. And so people are still relying on us as professionals to not only be able to go through the details of this data, but to know the story behind it. Many of those new construction deals that are on as announcements may become deals at some point, but they're not imminent. So they're not going to impact the rental market today. So really dialing into those details, but we are seeing buyers rely very heavily on what is known because there is a lot of unknown in the market today. What is known is from an expense standpoint is what it's actually been costing to operate this property. So gone are the days of like, oh, I know the owner is operating at $1,800 in payroll, but don't worry, you can do it for 1,200 by cutting this person doing that. They're spending 450 a unit in marketing, but don't worry, we can cut it down to 200 a unit because we're going to cut this, and this, and we're going to centralize this. Buyers just will not underwrite to that because they might, but when they go out and communicate with their equity wants what feels like a sure thing.
Yeah, I
Well,
agree.
and also for a couple of years, 21, 22, 23, almost every deal we had no retrades. Now deals are tighter, buyers are underwriting more carefully. So any little hiccup, uh, data error or property, something with a property that was not known that comes up during due diligence or financing can cause a problem. So it's more important than ever to do upfront due diligence and try to find all of these uh, underwriting issues that could cause hiccups later on to prevent a retrade and also to ensure closing.
Yeah, I feel bad for buyers today because if you made a deal 4 weeks ago and you got aggressive and you really were the top price, interest rates going up 30, 40 basis points, and then you find a couple issues during your due diligence process, you have to eat that or you're going like what else do you have to do? You can try and renegotiate the deal or you have to just say it's a worse deal than before, but we discovered all the issues.
Yeah, and these days, most people are asking for price adjustments.
Yeah.
It
Yeah.
was taboo 3 years ago to ask for price adjustments because the market was competitive and you didn't want to be known as a retrader. It's a little less taboo to ask now.
But I
Makes
feel
it all the
like
more
go
makes it
ahead.
all the more important too to run our process and make sure that as we're vetting buyers, we've completely understand what assumptions they're making, how much cushion they have. And if you don't, you may have found the needle in the haystack, but it might be a rusty needle.
Yeah. I feel like the retrades today, when they come, we're dealing with buyers that are better, more sophisticated, that's who we're picking at the top for the most part, or just someone that's good to work with. So when you get a retrade ask, it's not like, oh, I want $1 million, but I'll meet you at 300K. It's like, I'm going to ask you for what I really need, and I'm going to explain to you why, and then let's have a discussion.
They're not sport retrades, they're deal point, real deal issue retrades.
And we still have deals that close with no retrades.
Don't forget.
We
For,
do.
for the ones where they're thoroughly vetted up front, where we identify all the issues and disclose them and make sure the buyers know them.
Well, this feels like a good point to pivot on to what deals are happening. So we thought we would highlight for you four of the 24 transactions that we have closed this year and give you an idea of how buyers are underwriting, how they financed it, what cap rates they were looking for, some real time behind the curtain facts on deals that have closed. So I'll go ahead and start. I'm going to, for those of you that are watching this on video, I will share my screen, which will give you an overview of, you'll see an OM for a deal that we closed at the beginning of this year. So this will likely be the largest transaction for the year, or maybe for a couple of years, on both price and size. So this is Canterbury Green apartments built in the late 70s, early 80s in multi-phases because it's 2,000 units. It's in Fort Wayne, Indiana, which I'm from, the northern Indiana area, just north of Fort Wayne. So this deal has been something that's been on my radar since I literally was in high school. And so I remember going there in high school, visiting a friend's older brother who lived there, and being pretty amazed by it because it's its own little city. It has a 18-hole golf course that runs through it. It has many different phases. It has some single story units. It's a really cool property. It was built by a Fort Wayne developer that is no longer with us, that built this and many other properties in northern Indiana. And so we brought this to market at the end of last year with the expectation that it's a big deal in a secondary market, that we were going to have to really work hard for that needle in the haystack buyer, and that we tempered our clients' expectations that we'd probably get somewhere between 6 and 8 real offers. We brought it to market. We were pleasantly surprised. We ended up actually with 10 offers, and we had real competition at the top, and ended up having 3 groups at the top that all were really fighting for pricing, that had the ability to buy the deal, had either captive equity through a fund structure or good connections with equity. And we felt that they had the ability to close this over $200 million transaction. We ended up selecting Morgan Properties. So Morgan Property is one of the nation's largest owners. They aspire to be the nation's largest private owner, which may happen even as soon as this year. They're kind of 2 or 3 right now. The last year they closed over 10,000 units, and they love big properties. They know how to operate large properties, and we had a good track record with them of selling them large properties. We've sold them over 1,300 unit property and over 700 unit property, and they own in the Fort Wayne market. Their equity on this is an international Middle Eastern based group. It's Oleon Capital was their equity, and their equity, Oleon was also in their other deals in Fort Wayne, and they had success there. We had talked about data. We spend a lot of time assisting Morgan and getting their equity partner comfortable with Fort Wayne. And one of the ways that we did that is we showed them 20 years of rental data. So George started selling multifamily properties in the 80s, and was secret sauce. What he did that is being a data provider, because there wasn't CoStar, Yardi, Axio. Before those things, there was George Ticketjon. So we do our own rent survey. So we have data going back 20 years in Fort Wayne, which frankly nobody has, because nobody was surveying. Those data providers, one, didn't exist 20 years ago, and they weren't surveying Fort Wayne. So we had the ability to go back 20 years. And during that 20-year time period, there was not a single year of rent decline, nor a single year of average occupancy below 90%. And that communicated the stability of this market. So Morgan Properties got their equity partner on board. They closed earlier this year. They are planning to continue to improve the property. I said there is a golf course. They're actually closing that golf course down. It was a, kind of older, local, open to the public golf course. They're going to make it more of an amenity for the residents. That's going to be walking trails and a beautiful green space, and offers them the opportunity to potentially do some add some additional units. The property, we were promoting a cap rate of 7% year one without doing any additional upgrades. The property closed at just over 200 million, which was a 6.2 cap on trailing, and a forecast cap rate for Morgan. It was about 675. And by year 2 or 3, they'll get a cap rate that starts with a 7. CBRE debt did provide the financing on this. It was agency friendly financing, and big transaction. Like I said, probably the largest transaction certainly this year and maybe for a couple years. So it was good to get a deal done over $200 million this year.
That was a really cool deal. My favorite part of it though is when you closed it and you did the Fort Wayne News interview. They replayed it in our lobby. I was like, Hannah's a local celebrity now.
The deal was truly near and dear to my heart. I have a very vivid memory of both of them. I'm from a very small town in northern Indiana, and this was like my first interaction with going to a big apartment community where tons of amenities, and I remember it. So it's funny that 30 years later, and our team had the ability to sell it. So it's exciting. It's the biggest deal, obviously, in Indiana from a unit count, and one of the largest in all of the Midwest. So it was a special deal for our team.
Yeah. Yeah. So another deal we wanted to talk about was Signature, which Signature is a beautiful Class A property in Carmel, Indiana, fully amenitized, brand new property, fully amenitized with golf simulators, outdoor patio amenities with all the outdoor games, and a big pool, outdoor pool, like every amenity that you can think of, work from home pods, and just an awesome property, awesome location. And if you talk about conviction, it felt like the answer to every typical buyer complaint was there. It's like, well, there's a bunch of supply in Carmel that's come up over the past few years. Like, yep, there's a new mayor. The mayor is leaning towards owned housing, so the new supply will likely taper off quite a bit. Well, there's retail on the bottom, and we don't do retail. Well, it's condoed out. It's actually sold to one of the tenants themselves, so they're going to take care of it. You don't have to deal with it. Well, I'm concerned about real estate taxes. There's a TIF bond that offsets the increases in real estate tax over the year. Like every single answer felt perfect. And at the end of the day, you think, who did you guys sell that property to? It's almost an $80 million deal. Who did you sell it to? Blackstone, Ares, whoever? Local Burgeon-Held. It's amazing. But it kind of plays into the story that we're telling. It's that $80 million deal, the equity check is hard to raise. And even though you have answers to every single complaint along the way, who understands that deal more than anyone is a local buyer. And who is the equity behind that local buyer? Local people that understand that Main Street Carmel is the place to be, that the city as Carmel continues to grow from the Arts and Design District west, which is happening. This property is in an awesome location today and in the path of progress to be going from an A+ to an A++ type location. And it was a very fun deal to work on. It was definitely one of our more competitive deals, 20+ offers, all of that. But it was amazing to see who ultimately showed up on that bid sheet.
That's right. And one of the things we said about that deal too is that it also speaks to local knowledge and the power of relationship. So Burgeon-Held purchased the property. CRG built the property in partnership with Great Lakes Capital, and there were some things that came up. There were 8 condo units that we were going to be selling with the multifamily side, ended up separating those. And they also, Virgin Health needed some additional time because they were going to use an institutional equity partner, and that changed. And so there was enough relationship between all of the parties there that there felt a comfort level that when Burgess said, I'm going to get it done, they got it done. It was the 32nd transaction that we closed with Virgin Health, and the process did take longer because of many things out of control of really many of the parties, but it got done. And that is a nuance of transactions today is they are generally taking longer to get done. Lenders are scrutinizing deals more. Third parties are taking a little bit longer because they have extra levels. Appraisals have now extra levels of data that they have to provide they didn't have to before. So the sellers that are being successful in the market today not only are meeting the market from a pricing standpoint, but they're willing to adjust terms to give people the time they need to either raise the equity or to complete their process or to finalize their financing. And they're just about every single deal that we do right now has at least one extension right because buyers want to know that they have the ability, if something comes up, they have the ability to have the time that they need in order to get it done.
It sold at a 5 cap on Virgin Health's underwriting. So that's probably in the market today about the lowest cap rate we'll see. Most buyers for Class A newer properties are looking for closer to 5.25 to 5.5. But again, Carmel is the premier market in Indiana, so it's a market that justifies a bit of a premium. And
That's right.
I'm sure private investors understand the distinction of how special Carmel is and what the growth potential for Carmel is more easily than institutional investors. So that's why on some of these deals, we're seeing private syndication or friends and family that will pay more than investors with institutional capital because they see the story, understand the story better. They're on the ground, they know the real estate. Institutions are trying to fit investments in boxes, and sometimes it doesn't always work that well.
George,
Next
tell us
one
about
is
a Northwest Indiana deal that we
yeah.
closed.
So we put 2 properties on the market in conjunction with our Chicago team, Jason Zick in particular, for a Chicago area family that had owned them for about 20 years. One was called Kennedy Crossing. The other one was the Orchard. Kennedy is in Hammond, Indiana. Orchard was in Porter, Indiana. Kennedy it's a large property. It's 353 units. It was stable operations. The family had owned it for a long time. They bought it distressed, so they had a low basis in it, and they basically ran it and kept it full and spent more money on upkeep just because that's the way they do business. They keep their properties up because they own it for a long time. So we had a buyer based in Minneapolis who thought that there was an opportunity to buy a large, stable deal with, I think they underwrote probably $200 potential rent increases and some decreases in operating expenses. They also put the other property, Orchard, under contract. Orchard in Porter had a lot of upside. The property was built as a tax credit property, and the current owners had run it pretty much as is. So that is a fairly affluent market. So we were marketing it as an opportunity to do a pretty dramatic value add improvement. While it was under contract, unfortunately, the property got hit with a very large real estate tax increase that the buyer just couldn't overcome that increase in tax. So the seller decided that they were going to, both properties had loans coming due. That's why they strove to sell it. They decided they'll refinance the property in Porter that they'll refinance the property in Porter. They'll do some of the work themselves, create additional value, raise rents, and then sell it in a few years. So, and by the way, we were under contract with Kennedy Crossing in Hammond before the Bears announced their site in Hammond, the golf course that's not far at all from this property. Now, talk about that Bears move to Hammond has gone kind of quiet in recent weeks, so I don't know what's happening there, but that might end up being a lot of luck for that particular buyer.
That's right.
Okay.
But I feel like our buyer there was the ideal 60s and 70s vintage property buyer. They bet big on their own operations. They're like, we know how to run these old properties. This is what we do. And when they showed up to due diligence, they showed us that. They scoped all the lines below the ground, the sewage lines, and walked every unit and really dug into the details, which in some ways is nice, right? Because dealing with an organized buyer on that type of deal is really,
Yeah, they were used to older properties. The property was built in the early 70s, so they weren't afraid of it. And they have a guy who I was with when we were doing due diligence. His whole role for the company is dealing with underground utilities. So he scopes sewer lines for a living. So again, he's not afraid of what he sees.
Love it. Sean, bring
wow.
us on with a deal story from a deal that's about to close in the Louisville market.
Yeah, so Beech Grove is part of a 3-property portfolio. Beech Grove in Jeffersonville, Indiana, so Louisville MSA, one near Cincinnati, and then one in northern Indiana and Elkhart near South Bend. Beech Grove is 182 units, 70s vintage, and located in Jeffersonville, Indiana, which when we launched was still recovering from a lot of supply in 2024 and 2025. So the newer construction properties were in lease up. There were lots of concessions in the market, and Beech Grove itself has struggled in occupancy. It was in the mid 80s on T12, but had improved. At the time we launched, it was 93%. So, understanding what was going on with the supply pipeline in Jeffersonville was critical because it had tapered off significantly. And part of what we were selling was improving occupancy. And we needed to demonstrate that in the data when we went to market. And fortunately, the property proved it out while we were marketing. So we started, when we launched, it was 93%, which was a 5.5 cap on in place for 70s vintage. So very aggressive. By the time we made a deal, however, they were high 90s occupancy and it was a 6 cap on in place, which made sense for this buyer because it was excellent leverage and below market interest rate as a 4.92 interest rate with great leverage. The balance was close to 15.2 million. So over 80% leverage, which is why it made sense for this buyer. We had good exposure for it. We had 77 CAs, 13 tours, most of which were in person, and 20 offers. And ultimately, the buyer ended up being a local Southern Indiana group who is using all of their own capital. So they own about 1,000 units. They're very disciplined operators. Most of their portfolio is 60s and 70s vintage, and it's very clean. They were a group who, at the outset, it made sense that they would be interested in the property, but haven't historically participated in broadly marketed processes for a property of this size. So it took some encouragement to get them to participate, but once we really dug into it, it made a lot of sense to them because they were able to add 182 units with only about a $2 million capital outlay. So it made a lot of sense for them. They could bring their construction crews from other properties over here, and they're very anxious to get it closed. It's a loan assumption, so at this point, we're just waiting on the master servicer. But great process, and it was another instance where understanding the market and the players was crucial, and going out and seeking the buyer, finding the needle in the haystack was what helped us get to really strong price in there. We're around 96 a door.
Great. Great. Well, that's a good overview of what we're seeing in the market, both in terms of transactions that have closed, buyer sentiment, what we're hearing in terms of how people are underwriting, how equity is impacting the market, and interest rates, and a war. The moral of the story is that there are still deals getting done. There's still a very active sales market. There are plenty of sellers that are willing to meet the market, and buyers that are willing to pay pricing that attracts sellers to sell. So we welcome you to continue to take a look at the properties that we have on the market. And we are going to go now and sell some deals because, as George says, you're only as good as your next deal. Thank you guys for joining.
See you guys. Bye.
Thanks. Bye.
Thanks for tuning in. Stay in the loop by hitting that subscribe button and check the show notes for additional resources.